Hello, everyone, and welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucian. Some of you know me as Triangle Investor from X. After a very successful interview with Rick Rules three weeks ago, more than 50,000 views and excellent feedback from all of you good people, on which I am very grateful, I decided to invite Rick again in my show, and he, as always, was very kind to join me for another round of great chat. Rick, thank you very much for coming again.
Lucian, it's a pleasure. I enjoyed the first interview. I'm glad your audience did. By the way, I rebroadcast it to my own audience and got very positive feedback. So thank you for conducting a great interview.
Thank you, Rick. If you missed our first interview, I will leave the link in the pinned comment so my viewers can watch it. Rick, before we start, I want to say I'm looking forward to attend the Rule Symposium in July, where I look forward to be in your company and in the company of some world resource mining big and legendary names. If some of my audience is considering to come to Boca, the link of the event will be also below. Rick, let's start with our interview, and I want to start with hate. You and I both love hated commodities, so my first question is, what commodities are on the top of your list as the most hated right now?
Well, I think there's a fair bit of hate in the commodity space, actually. Platinum and palladium have been falling fairly precipitously in price, both due to the misconception that the internal combustion engine in the near term is going the way of the dodo, which is false, and also as a consequence of Russian selling. We saw this before in 1990 and 1991. When the Russians need money, and they need money, they sell whatever they have in the cupboard, and part of what they're selling is platinum and palladium. So I'm attracted to platinum and palladium. I believe they go lower before they go higher, and I believe that the hatred intensifies. But I'm learning all I can about advanced exploration projects for platinum and palladium, particularly those few that are outside of South Africa and Russia. I think this is probably more a 2025 theme than a 2024 theme, but you need to get yourself ready for the themes of the future. The second theme of the future, I suspect, is lithium. Yesterday's darling is today's pariah. Since we like hate, Lucian, there's no hate that is more profound than the hate of a jilted lover. And lithium found itself literally millions of lovers over the last 6 years. The narrative, of course, was a lithium-ion battery. The supposition was that we didn't have very much lithium. In fact, we had lots of lithium. We didn't have much lithium processing capacity. So after having risen fivefold, the price of lithium fell by 75%. Looking for lithium, we found some. In fact, we found a lot. And the market's going to have to digest that. A year from now, 2 years from now, boredom with lithium or fear of lithium is going to turn to hate for lithium. And as you say, I love hate. So I'm looking forward to learning more about the lithium business. And then finally, sulfide nickel. The nickel price is depressed also partly because of Russian selling, but particularly depressed because of the explosion of lateritic nickel mining in Indonesia, particularly on Sulawesi. I flew over those mines 4 or 5 months ago, and the environmental devastation wrought by those mines is breathtaking. I believe that lateritic nickel production continues to increase in Indonesia for as much as a year. But when the increase in lateritic nickel production plateaus, I think that you're going to see a real profound return in nickel. Meanwhile, in sulfide nickel, in the sulfide nickel business, it is so unprofitable that sulfide nickel deposits are shutting down around the world. That is profound hate. Once again, I love it. I should point out too, if you'll allow me to go beyond hate to boredom, you've seen, increases in the gold or silver prices, but there's still no retail support for gold or silver. The truth is that the gold price in particular appears to be increasing solely as a consequence of central bank buying and some retail buying in China. In Europe and in North America, the data from the ETFs would show that there's retail selling, not retail buying. So while neither gold or silver, well, perhaps silver, are exposed to investor hate, I would suggest to you that they are still confronted with investor boredom. And I think that that boredom will change to fascination over the next 5 years.
Yeah, good point on especially on gold. Rick, your recommendation was to hold 10 to 15% in precious metals. For people that understand the risk of speculation, would you feel that it is a good time for a number of reasons to raise that allocation to 20, 25% maybe?
It depends on the investor's net worth. It depends too on the investor's sophistication. For myself, I have a rather large gold allocation in my portfolio, although a financial planner would say that that's stupid, given the fact, as an example, that I'm the largest shareholder in Sprott. Should the gold price go up, the shares of Sprott would go up. I don't need that gold, but I consider my physical gold to be both insurance and liquidity. For many investors, their physical precious metals aren't liquidity. They don't regard them as money. They regard them as an investor, and they're unwilling to sell them.
Yeah.
Those investors who don't regard their physical precious metals as liquidity would be well advised to limit their holdings of gold and increase their holdings, as an example, of US dollars to maintain some form of short-term liquidity. So the answer to the question, Lucian, sadly depends on which investor I'm talking to and what his or her risk tolerances, time preferences, and willingness to work are.
Got it. What about platinum? In the past, you said that you felt platinum would be the biggest beneficiary in precious metals bull market. Do you still believe that?
I own some platinum, but I own it as a speculation. I own platinum because it's oversold, and I own platinum too as a speculation because there are really three countries, well, really two countries that matter in the platinum business. South Africa, which is a basket case, and Russia, which is a basket case. And if there were social or political constraints, internal political constraints to the production of platinum or palladium, I think that you would see the price of platinum and palladium go absolutely crazy. It's important to note that in platinum and palladium, the primary use is as an autocatalyst for catalytic converters. You don't see political pressure around the world for more smog. So as long as we have the internal combustion engine, you're going to have demand for platinum and palladium. It takes at current prices about $110 worth of platinum to produce a catalytic converter that allows the sale of a $50,000 or $60,000 car. If the platinum price were to double, it wouldn't impact the finished price of the car, nor the demand for automobiles. This is true price elasticity. If you had a hiatus or an interruption in production in South Africa or Russia, you could see the platinum and palladium price double, and it wouldn't change industrial demand for the commodity at all. I'm not saying this is going to happen, Lucian. I'm just saying that as a speculator, the idea where I don't have much downside and a foreseeable event, while not probable, that is possible, that could give me a double or better, is intriguing to me. And so I have an allocation.
Got it. What do you think, who will be, what commodity will be the best beneficiary of inflow of capital in the months to come?
If you're talking about the equities, the producer equities,
yeah.
I certainly believe that's copper.
Copper.
I believe that there is a consensus around real money that absent a synchronized global recession, that we're going to face moderate to severe shortages of copper within the 5-year time frame.
Mm-hmm.
You saw an announcement, or perhaps you didn't, perhaps your audience did or didn't, see an announcement from Rio Tinto the other day saying that, as an example, copper is their focus.
Yeah.
Saying too that there aren't very many high quality copper assets to buy, so they're going to have to build them. They said a whole bunch of things in that quote. What they really said is that for 30 years, the world, including themselves, has underinvested in copper exploration, copper development, and copper production. Meanwhile, the world has continued to use more copper. We are facing a huge structural deficit in copper as the world electrifies, which is to say, as demand for copper increases. I think the collision between supply and demand in copper is on everyone's mind. And I think that capital is flowing to copper and will continue to flow to copper.
We always talk about cost of capital for project when it comes to financing it. However, since most financing comes from debt and the equity portion, what do you think about the true cost of capital when the equity component is not known until financing actually happens?
Well, as I'm understanding the question, first of all, you need to bifurcate the cost of debt into investment grade and non-investment grade.
Yeah.
The Exxons, the Rio Tintos, the BHPs of the world, who can finance on balance sheet, get project debt that's effectively done at prime.
Yeah.
But the acquisition of capital by people who aren't investment grade, the acquisition of capital by people who have to do project debt, your audience needs to understand that irrespective of what the front of the offering memorandum of the debt looks like and what the press release looks like, the true cost of debt, project debt in a non-investment grade circumstance, is around 15% in US dollars, sometimes markedly higher. The press release might read 8.5, or it might read LIBOR plus 4.5.
Yeah.
That doesn't take into account original issue discounts, off takes, or other mechanisms by which the true yield is up in the 15% range. With regards to the equity part of the finance, it's interesting to look at the whole range of quasi-equity that we're seeing now. An example would be streams, of course, where the companies are selling an interest, at least an interest in the upside, in the price of a co-product like gold or silver. And that's actually treated like quasi-equity. It doesn't show up as being senior to the debt, which means that the lenders like it, but it also isn't necessarily equity, which leaves, in the right circumstance, much more upside in terms of capital appreciation for the equity holders. It's interesting to me that so many issuers in the world are suggesting that they're selling at 50% discounts to net asset value. If that's true, their cost of equity capital is very high. If you amortize that 50% over 3 years, as an example, in terms of construction finance, the cost of equity is 17 or 17.5%, assuming that you wouldn't get a re-rate with successful completion.
Yeah.
I would argue that most of the companies who suggest that they're selling at a 50% discount to net asset value have miscalculated their net asset value, however.
Agreed. Rick, you have participated in a lot of private placements, both as an investor or as a giver of capital. In which sector or commodity have you done the most private placements?
Well, irrespective of commodity, I've focused on the exploration sector because the exploration sector is traditionally the riskiest and the one that has rewarded doing the work better. Most of my competitors in private placements use the technique, quote, got a hunch, bet a bunch. I have always hired very high quality geologists to help me assess exploration projects. And I'm lucky enough at age 71 to be on a first name basis with most of the successful public company explorationists in the world, which means that I can allocate capital to good people rather than the lame, the halt, and the blind. It's worthy to note, of course, that you go through periods where the terms on private placements haven't been attractive relative to the rest of the market. I have found myself in the last 4 years focusing on the aftermarket rather than on private placements, for the simple reason that for whatever reason, other investors haven't demanded warrants. They've been willing to accept restricted stock, but they haven't taken warrants. Traditionally, when markets were tighter, sometimes I had to do private placements because in order to get enough stock to satisfy myself and my clients, I had to do a negotiated transaction. For the last 18 months, all I had to do to get the right size amount of stock was put a bid out there in the aftermarket, and disgusted investors would fill me with no restriction. But I look forward to returning to the private placement market in 2024, in this year, again, particularly in the exploration sector.
Any specific commodities?
I don't care. I'm agnostic as to commodity. I mean, do I like gold? Yeah. Do I like silver? But I'd be willing to make money in sand and gravel or lime.
Okay, okay. Rick, is there a better commodity than uranium to be right now in? I mean, when we look at the fundamentals, supply demand picture, etc., which other sector or commodity could actually compete with the uranium fundamental numbers?
Well,
Copper, yes.
what's hugely proper for the right way to think about uranium now is that the price doesn't have to go up.
Yeah.
So if you require the psychological satisfaction of a higher price quote, it's the wrong commodity for you. What has changed is that the structure of the uranium market has evolved in a fashion which has never happened in a resource before, which is to say that the industry is going to term or contract markets. What that means is that uranium companies can lock in minimum downside pricing for as long as 15 years, which gives much greater certainty to the lender and to the shareholder as to the selling price and eventually the margin. So I like to say with regards to uranium that the easy money has been made. It's off the table.
Yeah.
The easy money occurred when the commodity went from hated to tolerated to liked. It's not to loved yet, but to liked. The sure money for 10 or 11 companies with real deposits that work at this uranium price is ahead of us. What I think is interesting is I think that the pricing model in uranium, which is to say agreements between producers and consumers, will within 2 years begin to extend itself to the lithium market. And if that occurs, and lithium, as I suggest, becomes the subject of hatred, I think that there's a potential in, say, 2026 for the same circumstance to take place among the higher quality lithium developers that we will see in the uranium space. But for the next 5 years, simply paying attention to, as well as you can, the terms in the term market and understanding the impact that has on net present value and certainty means that the surest money in the resource space is probably in the uranium business.
Good point. Rick, you oftentimes comment on nuclear utilities that need 3 billion debt to construct a new nuclear power plant are forced by lenders to purchase uranium before getting approval for the debt. I would like to hear more details about it, if you can expand.
Well, first of all, 3 billion is a conservative number. Most of the new nuclear power plants, assuming they're efficient ones, which is to say Chinese ones built in a permitting environment which is tolerant, most of those plants have upfront capital costs of between $7 and $8 billion. And the current structure around these plants is that 65 or 70% of that number is project debt. 65% of $8 billion is what, 5 and change. So the number, rather than being 3, should probably be 5. Because you have a market where uranium is a fairly small component of the operating cost of a nuclear power plant, and is small compared to things like capital costs. What the lenders are increasingly requiring is that power plant owners have access to enough fuel over a long enough period of time to amortize most or all of the loan. If there's a 15 or 20-year loan, the lenders are asking for at least 10 to 15-year supply agreements. This is really important if you have one of these big new Chinese plants that will be burning, let's say, burning is the wrong phrase, consuming 500,000 kilos of uranium a year. The lender would like to see the plant owner contract for between 300 to 500,000 kilos of uranium a year for a period of time long enough to substantially amortize the loan. What that means is that a producer can reasonably expect to lock in contracts that give the utility some security of supply and some price certainty, while giving the company itself at least a minimum guaranteed price. It's important that investors who are taking this into consideration understand, too, one other qualitative comment. The counterparty in this, in order for the certainty to be high, must be an investment grade counterparty.
Mm-hmm.
If they're selling a supply contract to a trader, a uranium trader, that is financing their purchases in the overnight capital market, that's not the same as having as the counterparty Tokyo Electric Power or China General Nuclear or Duke Power. It's important that when you apply this process to investment analysis, that the term contract counterparty needs to be an investment quality borrower.
Mm-hmm. Rick, what about future for oil and gas? How do you see
it? I'm prepared to believe that as Middle East hostilities begin to subside, which I hope they do, that the spot price, the near-term spot price on oil comes down. I also hope that the conflict in Eastern Europe between Russia and the Ukraine subsides. I'm not an analyst, so I'm not saying it's going to happen. If you had a more unimpeded flow of Russian hydrocarbon into world markets, you might see some reduction in price, although it's important to say that the sanctions haven't impeded the flow of Russian oil at all. They've just caused Russian refined products to become Indian refined products. But let's leave that aside. The real issue around oil and gas, or issues, are twofold. The first is that the big thinkers in the Western world would prefer that you and I didn't use oil and gas. Not that we care much, but oil and gas are politically incorrect fuels. And what that does, among other things, is raise the cost of capital for oil and gas companies. It's now difficult, not impossible, but difficult for oil and gas companies to get property and casualty insurance, super catastrophe insurance, environmental remediation and bonding insurance. So at the very bottom of the capital stack, things are more expensive. Debt capital is harder to attract. Some of the big providers of debt capital, big banks and big insurance companies, are backing away from the oil and gas business because it's politically incorrect, which raises the cost of capital. At the same time, the industry itself, given the political headwinds that they face, are reducing their capital expenditures. It is estimated by the International Energy Agency, by the way, no friend of the oil and gas industry, that oil companies, including state oil companies worldwide, are underinvesting in sustaining capital investments to the tune of $1 billion a day, $365 billion a year. This is a capital-intensive business. If you don't make the sustaining capital investments, you reduce your ability to produce in the future. So ironically, the big thinkers of the world, the folks in Brussels, the folks in Washington, the folks in Ottawa, are making the oil business a better business by constraining investment and reducing supply. The big thinkers, the morons in the US Congress or the morons in Brussels, will tell you that peak oil demand occurs in 2030 or 2032. One must ask them how they will fly 1,000 private jets to Davos to tell you and I to drive less if there isn't oil. The truth is that peak oil demand probably occurs in 2060 or 2065, and then tapers off gradually from there. Yet, sustaining capital investment is constrained, and new project investment is also constrained. There is a subset of oil companies, however, that are using the record cash flows that they're generating today to continue to make sustaining capital investments, to continue with new project investments, and despite that, be able to fund record high returns of capital to shareholders, either via dividends or via share buybacks. This is the rosiest circumstance that one could anticipate, particularly if one has a 5 to 10-year time frame. If one was a speculator, one might say, Rick, all that's true, but I don't live for 10 years. I live for 10 months.
Yeah.
If you live for 10 months, or if, as the parable goes, you don't buy green bananas, please understand in a year you're not going to have any bananas. But let's leave that aside. From a timing point of view, if you're one who believes that peace is going to break out in the Middle East, or that peace is going to break out in Eastern Europe, you should probably not enter into the oil and gas market. If you believe that peace is going to occur, oil prices will go lower for a while. But it's this dearth of sustaining capital investment that's going to propel, or at least maintain, the oil price over the decade and keep oil and gas investments as being, from my point of view, particularly attractive.
What about oil investments in places like Colombia? How do you see potential of oil and gas in Colombia?
Well, Colombia has absolutely spectacular geology. And that the exploitation of that geology has been constrained both socially and politically. In places like Antioquia, Putumayo, 15 years ago, you really truly had to deal with FARC, you had to deal with narcotraficantes. There were a whole bunch of reasons why you wouldn't want to drill there. Colombia, in a social sense, has become much more tame. The current president of Colombia would seem, like most politicians, to be a guy who wants to snatch defeat from the jaws of victory. He has decided in his wisdom to constrain oil and gas exploration and production in Colombia and rely on his benign, benevolent neighbor, the Venezuelans, to supply interim fuel to Colombia while he changes his country from a rational fossil fuel economy to, quote, alternative energies. Countries also always seem to be constrained by their leaders. And in the intermediate term, I think we need to look at how the Colombian citizenry will view the political impediments to oil and gas in Colombia that are imposed completely unnecessarily by their president. If these political constraints are addressed, the exploration upside in Colombia is limitless.
Good point, Rick. Excellent point. I learned a lot from it. Rick, we have come to the part of the interview that my viewers like the most, and that is like the last time. I have a list of 10 uranium, gold, silver, and copper companies on which I would like to hear your opinion, and you, if you hold them or they are maybe on your radar. Of course, these are just your opinions, and they can change tomorrow, next week. So people should not consider this as investment advice, right?
Yeah, let's revisit that disclaimer. News can change my opinion.
Yeah,
absolutely.
Like I said, tomorrow you can
absolutely overnight. So don't look at this information as an annuity.
Sure, that's the reason why I said this disclaimer. I want to start with uranium. The last time I didn't ask you about UEC, Uranium Energy Corp, Amir Adnani. What's your take?
It is a premium priced company, which is to say it is not cheap. It is probably the company that responds in the market the best to increases in the uranium price, because Amir Adnani has spent many years and many millions of dollars developing 100,000 person shareholder constituency who respond to good news. He has been an extraordinarily disciplined guy. When he had production, he shut that production down.
Yeah.
When the price of uranium began to fall, he decided that rather than take the cash or lose money, that he'd prefer to keep the pounds in the ground. And he used that 10 years to continue to buy pound after pound after pound. You are now going to see him return Texas to production. You're going to see him put Wyoming in production, which is to say you're going to go from no production to what may be 8 to 10 million pounds of production over the next 2 or 3 years. And then, of course, you will begin to see the beneficiation of the acquisitions that he made in the Athabasca Basin, in effect, the Kuwait of the uranium world. Despite the fact that UEC isn't cheap by any metric, I own a lot of it. It is fair to say, however, Lucian, that in the run-up that we've seen in uranium equities, I sold enough UEC that my remaining position is free to me.
So you are enjoying free ride now? Completely
free ride. And enjoying is the right word. Amir is a superb human being. He's become a good person, friend of mine.
I had a few talks with Amir and I concur. He's a great guy. Next one, Mega Uranium.
Mega is very interesting. I own it in effect as a holding company. It's one of those where the value of the sum of the parts is greater than the price of the whole. There is durably high G&A there, which bothers me. This is a closed-end fund with a very high management expense ratio. On the other hand, one could argue that you get the directly held assets, the uranium assets, for free. And these are formidable assets. Free is a very good price. I am a holder of Mega Uranium, and I would argue that in some senses, if you did conventional securities analysis, if you viewed their investment assets, as an accountant would, as redundant assets, the value of the redundant assets suggests that you get the real assets for free. By that metric, it is the cheapest of the uranium stocks.
Yeah. What about Power Metals Resources? They are not a pure uranium company, but they have uranium in the portfolio. Do you hold them? What's your take on them?
I am a power shareholder, but I don't think of them as a uranium company. I think of them as a mini merchant bank whose business it is to find promising resource assets and take them to market. If you are a speculator in power, you are a speculator in the process of the private to public transition, getting in on the ground floor because you create the ground floor. I wouldn't think of it as a uranium stock, despite the fact that, as you say, they have uranium assets.
Okay. Brandon Monroe, Bannerman Energy.
I love Brandon. He's a wonderful human being. I do not own Bannerman because I prefer big deposits. I think that will do well in the market because I think it's a well understood deposit. It has good grade. It can be financed to production, and the whole financial community loves Brandon, as they should. But I don't own it. I myself have a sort of a minimum asset target size of $2.5 billion US in recoverable reserves and resources. The consequence of that is that I prefer bigger targets than Bannerman is working on.
Okay, so probably something like Paladin that served you well in the past. Do you believe that they are too expensive now?
Edward or Henry Bonner? Paladin is likely, given political risk, coming to be fully priced until, and it's important that people get this, don't take away the headline fully priced.
Yeah.
Until you see the structure of the term contracts that they are able to sign relative to returning their mines to production. They could easily be a 10 million pound producer. And if you took that 10 million pounds and locked in a base price of 75 US with upsides, in other words, if you had price certainty on that output, then all of a sudden they become cheap again. They haven't done that until I have enough evidence to do a net present value calculation. I have to say they're probably fully priced. That isn't to say they won't go higher.
Okay, okay. Do you own Laramide Resources?
I do own Laramide, but I prefer Mega to Laramide, same management team.
Okay. What about enrichment technologies, companies that have enrichment technologies like Silex? Do you know anything about Silex? Do you own them?
Lucian, I'm embarrassed to say that over 45 years, my track record in technology and process is almost unblemished by success. I wouldn't want to burden your listeners with my opinion as to technology.
Okay,
So I would prefer not to comment. I'm
fair enough.
pretty good. I'm pretty good on the producing side and the exploration side, and the process and technology side. With the exception of something like Schlumberger or Halliburton, where I couldn't go wrong.
Okay.
Uh, every other time I've tried, I have gone wrong.
Okay. What about Western Uranium and Vanadium, George Glacier?
Again, to me, I think that stock goes higher because of the ethnocentricity of American investors. I don't like small deposits, and that's a collection of small deposits. So I don't own it.
Okay. Energy fuel.
Despite my high regard for the people, I don't own it.
Okay, got it. Energy fuels.
I don't own energy fuels for the same reason.
Okay.
I think there will be a premium paid, although I'm not sure there should be. I think there will be a premium paid for U.S. pounds. I think the U.S. Congress, in their idiocy, will subsidize domestic uranium after having tried to make it illegal.
Yeah.
But all that being said, I have minimum size criteria in deposits. Everything that can go wrong with a big mine can go wrong with a small mine, but a small mine can only ever make you small money, while a big mine can make you big money. So if I'm going to take the risk inherent in mining, I want it to be big, big stakes.
Okay. I have on the list two Australian-based developers, Elevate Uranium and or Alligator Energy. Do you hold any of them?
I don't own either Alligator, although I know the deposit fairly well, or Elevate. The only of the Australian-based juniors that I own is Boss.
Okay. Let's move to gold by starting with Empress Royalty.
Of course, I own Empress. I've been a vocal proponent of those people. I mean, one needs to know that you're really speculating here. It's subscale, which is to say that right now, a public company, because of the high overhead associated with a public company, is an inefficient format for holding that number and that quality of royalty. This is a very high quality human being, Alexandra, very high quality human being. And I think that she will be able to deploy capital in the future as well as she has in the past, which means that I am betting really on her capability and on the durable competitive advantage of being the royalty financier of choice for the Endeavour financial team, people who've raised $8-9 billion in the mining business hitherto. She has access to all the deal flow from Endeavour, which sets her apart from the other third-tier royalty companies. So I have a very large position there.
Last time I asked you about Lundin Mining, but I would like to hear your opinion on Lundin Gold.
Lundin Gold, I'm a shareholder. The job that they've done on Fruta del Norte has been absolutely spectacular. I was terrified when they put Fruta del Norte into production because of the polyphase nature of the deposit, the complexity of the mineralogy, and particularly because of the ground conditions that they were operating in. And I gotta say, Ron Hochstein and his team, with the assistance, of course, of the Gignac family, just aced it. They absolutely aced it. They got everything right. They exceeded my expectations by 100%. They exceeded the market's expectation by 30 or 40%. They've done a great job. The question is, where do they go now? They're generating a ton of cash. They have access to all kinds of opportunity. I'm almost certain that you're going to see them grow by acquisition. And if the Lundin's track record is any consolation, the acquisitions that they make will be intelligent and accretive. Ironically, when you make an acquisition, even if it's an acquisition that's accretive, often your share price goes down. If you are acquiring another company for shares, as an example, many of the shareholders of the company being acquired will have had their investment expectations met, so they'll sell the stock. So holders of Lundin need to understand that what will almost certainly be an M&A strategy for them will lead to volatility in the stock. Because I myself am not an investor with a 6-month time frame or a 12-month time frame, but rather an investor with a 60-month time frame, depending on the nature of the acquisition and depending on whether it's accretive, I will take advantage of any market weakness that ensues to be a buyer, not a seller.
Mm-hmm. Oceana Gold?
I don't own Oceana. I have from time to time in the past. I'm looking for fewer higher quality deposits, although I'm very attracted to the exploration success that they've been enjoying in Waihi in New Zealand, but I don't own them.
Okay. Next one, Centera Gold.
Centera, I don't own either. The reliance of Centera on a couple of assets that seem to me to be just attractive, or as my grandmother would say, good but not yummy when referring to food, means that I'm not a Centera holder. Highly leveraged to the gold price. And so people who are buying a gold stock in anticipation of a leveraged warrant against the price of gold, Centera is probably not a bad alternative for them.
Mm-hmm. What about NovaGold Resources?
I don't own NovaGold any longer. In terms of leverage to the gold price, it's delivered.
So you don't own it anymore, like you said. Okay, let's move to McEwen Mining, Rob McEwen.
I don't own McEwen Mining, which is probably a mistake. Rob McEwen is a superstar whom I've known for 30 years. He has just been incredibly tenacious and tough through a very, 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 very tough period. He has steered his company through all that. There is no premium in that company for Rob McEwen, and there deserves to be. This guy's one of my living legends. It's certainly one where I will look to add. By the way, I'll look to come back in NovaGold too. There's another superior human being. It's just I had performance expectations which were met.
Okay, Victoria Gold.
I don't own Victoria Gold. That to me is a determinedly tier 2 deposit. It's difficult to operate gold mines in the north. I've known the deposit for 20 or 25 years, all the way back to when Clive Johnson had it. It was tough to construct. It was tough to operate. Again, for people who want leverage to gold, and for people who feel better owning Canadian gold as opposed to gold in some other jurisdiction, it's likely a stock that works. But when I look at the history of return on capital employed, and to me, it's not one I own.
Okay, what about the Jaguar Mining?
Same thing. So far, at least, an extremely marginal deposit, and I'm just not interested in that. If you're looking for leverage, if you're looking for operating leverage or leverage to the gold price, a decent place to be. Leverage implies marginality, and I don't like to buy marginal businesses.
Got it. What about Lumina?
Lumina, I own a lot of. This is one where your leverage is exploration leverage. I understand the risks. Anytime that you're doing exploration leverage, you need to understand that the probability is that you lose money. Mm-hmm. The possibility is that you get a 5-bagger or a 6-bagger or a 10-bagger. And I have been remarkably successful in those types of efforts in the past. I love large deposits. Large deposits almost always give you good as opposed to bad surprises. I like good surprises. Lumina is not one for the faint of heart and not one for the risk averse.
Final gold, Tudor Gold.
I don't own Tudor. I'm not unattracted to it. But what I find is that Canadian exploration projects usually sell at a premium to exploration projects in other countries. So much exploration finance takes place in Canada, and Canadians, like everybody else in the world, are ethnocentric. Canadians seem to believe that Canadian gold is worth more than gold in other places. It doesn't follow, but it's believed to be true. The consequence of that is that I am much more likely to speculate on gold deposits in places that are believed to be more politically risky. I need to say that I consider Canada to be a politically risky jurisdiction. Where Tudor is, given that their host relationship is with the Tahltan First Nation, I don't believe that that's politically risky. I wouldn't invest in mineral exploration production in British Columbia outside of the territory of the Tahltans. But I've done business with the Tahltan Nation since 1984. And I can truly say that I love them and I trust them and I honor them. And I feel trusted and honored myself. So any remarks that I might make about Canada as a jurisdiction don't apply to the Tahltan territory.
Okay, let's move to silver. First on the list, Silver Corp Metals.
I own Silver Corp, but I don't talk about it much. I own it because I'm always afraid of the opacity of operating in China, particularly with regards to reserves and resources. I'm delighted to say that my relationship with Silver Corp goes back many years. The initial public offering took place at 35 cents, and I was the lead order. So I've been around them for a very long time. They are very high quality people. And as I say, I own them. I enjoy the dividend. I have a difficulty talking about them in public forums because of the opacity with regards to information.
Next, Gatos Silver.
Gatos is what I'm revisiting right now. Clearly, the financial results on a quarter-by-quarter basis are pretty good. The mine and the mill are operating well. What I need to get more comfort with, the same with Silvercrest, frankly, is reserves and resources. Both companies disappointed in the transition from bankable feasibility study to nameplate capacity with reserve and resources downgrades. Both companies have said that they will devote sufficient capital to drilling that they can refresh the market's view to reserves and resources. And in both cases, I need to be able to see the data and be made to understand it.
Okay, next on the list, Endeavour Silver.
I don't own Endeavour. Again, I have a bias against small mines, and I have a bias against high all-in AISC.
Fresnillo?
Fresnillo I own. Fresnillo is a very high quality silver producer. Investors need to know that Mexico is getting riskier. And investors need to know with regards to Fresnillo and Peñoles that the current president of Mexico, jokingly called AMLO, does not like the caciques, the sort of oligarchs that run Peñoles and Fresnillo. So if you are operating commercially in a country where the political class doesn't like you, you run real risks. And in Fresnillo and Peñoles being the control shareholder of Fresnillo, you need to take into account what is at best antipathy from the political class.
One from my neighborhood, Adriatic Metals.
I'm a large Adriatic shareholder. Been there for a very long time. It's treated me very well. It's one of the few that I was able to get in early on at much lower prices, where I haven't gotten a free ride, where I haven't taken the point of no concern. My experience has been that volcanogenic massive sulfide deposits, which I think this is, occur in clusters. And the company went to production having identified, depending on your viewpoint, 2 or 3 ore bodies. My belief is that this won't be a mine, that it'll be a camp. My belief too, because of the grade of the deposit, is that they will be able to achieve nameplate capacity within 6 months, and that the stock will come to be viewed rather than a silver, lead, zinc development story as a silver producer with lead and zinc byproduct credits. In other words, I think if they're able to achieve nameplate capacity, which I believe that they will, that the stock will re-rate and re-rate substantially.
Yeah, and some great guys behind the company. I met them.
Correct.
Yeah.
Correct. And there would seem to be, you would know better than I, but there would seem to be a lot of community support.
Yes,
around
definitely,
that deposit.
definitely. It's a good jurisdiction. Next on the list, Hercules Silver.
Too early to say. I own it. The initial drill hole, the photographed core of that hole, I just couldn't resist but buy. I was rewarded with an immediate 30% loss, of course. So, time will tell. It would appear that there is a decent porphyry that drove all those ratty little silver veins that the company was chasing. That first hole was mammoth. If they can drill a few more of those, this is exploration speculation at its grandest, which is to say it's going to be a rodeo ride. The likelihood, of course, is that I get thrown off the horse like most rodeo rides.
Yeah.
But if I manage to stay on for the 8 seconds, it's going to be a long ball home run.
Yeah. What about Kootenay Silver?
Don't own it. Used to own it. Have been for a long time attracted to the exploration upside. I haven't seen enough data to allow me to re-enter the stock, but it's one I'm favorably inclined towards.
Next one will be Skeena Resources.
Skeena is the one in the triangle that I continue to own. There will be some metallurgical challenges with regards to that deposit, but it's one of the highest grade open pit deposits on the planet. There's a lot of data behind it, and Skeena has done a superb job with their hosts, the Tahltan, to the extent that the Tahltans are shareholders. The most sincere form of Aboriginal reconciliation is, of course, ownership. And that's occurred in this circumstance. The relationship between the community and the miner is tight enough that the community owns part of the miner, which is a very good thing.
Discovery Silver is next on my list.
Don't own Discovery Silver. I can't tie the drill holes together. I can't make a deposit out of it. I noticed that they're doing a financing that for warrant holders might be attractive. I just can't bring myself to that name.
What about GoGold Resources?
I own a lot of GoGold. I believe that, again, you have something that isn't a mine, but rather than a camp, a series of mines. I'm attracted now to the fact that their exploration seems to be predictive. It would seem that the geological crew knows enough about the genesis of the deposits that when they propose a thesis and test it, that they're getting consistently good results. In my experience, when you reach this point in exploring a district that you come to know, when the drilling becomes predictive, when the exploration becomes predictive, this is the time when you really add ounces. So I'm attracted to it. I'm attracted to it too because of the rather high silver ratio in the ores. I think it's not unlikely that as these projects get put into production, it comes to be viewed as more silver centric than gold centric, and I think that the market will like that. Note, of course, it's in Mexico, so you are exposed to real rather than imaginary political risks.
Yeah, agreed. Let's move to the final group. That's copper. Let's start with the giants, BHP first.
If somebody has a 10-year horizon, which I do, surprisingly at 71, I think I'll be here in 10 years.
Of course you will.
I don't think you can go wrong owning BHP and Rio. You enjoy humongous cash flow from the iron business. You enjoy almost oligopolistic stature in copper, and you have a development pipeline in front of you for the next 10 years with access to the capital.
Yeah.
Now, could we have a recession? Could the copper price go down sometime between now and 5 years from now? For sure. But if you believe in the resource thesis, if you believe in the fact that as a species, we are going to materially increase the living standards of the poorest of the poor on Earth, which we've been doing for 40 years, you own BHP.
Yeah.
And if you're concerned about the time frame, understand that you're getting paid a huge dividend from a fraction of their free cash flow. Now, for speculators, BHP is going to bore them to tears,
Yeah.
Which is fine with me. I'll just sit back and collect my dividends and watch the stock drift higher for the rest of my time on the planet.
So the same thing goes for Rio, right?
Absolutely.
Okay. Let's
Absolutely.
move then to Arizona Metals Corp.
I can't wrap my head around Arizona. I mean, I like it. Again, in culinary terms, my grandmother would have described it as good but not yummy.
Yeah.
I like the fact that they're on fee land, which means that they don't subject themselves to the vagaries of Arizona or American voters. It's not like Resolution where they're going to be 28 years in permitting.
Yeah.
I like the grade. It's the juxtaposition of size to grade that bothers me. I regard it as good but not yummy. I like everything about it, except I don't see the size to intrigue me yet.
Mm-hmm.
It is located on a highway. It's got water. It's got power. It's adjacent to a community that's got a lot of labor, some of whom work in mines.
Yeah.
Everything about it is right. It's just not big enough for me.
Okay, the next one would be Southern Copper.
I'm a little less attracted to Southern Copper than I am to BHP and Rio, or for that matter, Lundin Mining. What I like about it is it's cheap. On financial metrics, it is very, very cheap. I don't own it simply because I had too many viable alternatives.
We mentioned Centera Gold, but they also have a copper project, right?
They do. And I think you have leverage there, but it's a determinedly tier 2 asset.
Mm-hmm. Mm-hmm.
They get a lot of love for it because it's in British Columbia. And
Yeah.
Canadians, again, don't think that they live in a politically risky jurisdiction.
Mm-hmm.
If Canadians would look at the budget that was proposed by their prime minister a couple of days ago, they'd understand just how risky that jurisdiction is.
Good point, Rick. What about NGEx Minerals?
I own a boatload. I owned it for a very long time. My investing relationship with the Lundin family goes back to either 1974 or 1975. Both with regards to NGEx and Philo, I was an early shareholder. In both cases, because they're exploration companies, I have taken enough off the table that I have no exposure, financial exposure, into the rest of my position. Make no mistake, this district, the Vicuña district, will be an extraordinarily important source of copper, but it may not happen soon. I've been there. This is truly in the middle of nowhere. While Argentina is improving as a jurisdiction, one wonders if the voters will have the patience for the reforms which have been promised at the top of the country. Attracting mining capital to Argentina as a consequence of the vagaries of Argentine politics has been a problem. And putting the Vicuña district into production, the entire district, will be a 10 or $12 billion exercise. My belief is that eventually you see NGEx and Philo upstreamed into Lundin Mining.
Mm-hmm.
The project will still be too big for Lundin. So it's likely that once the projects have been upstreamed into Lundin, that you'll see a third party brought in by Lundin. all of which is to say, if you own NGEx or Philo, don't expect immediate fireworks. This is going to take place over the very long term. But the size of the prize is stupidly high. And the people behind it are just unbelievably good people.
Yeah, but a long-term play, like you said.
Yep.
Okay, next one on my list is Solaris Resources.
You have a good list. I own a lot of Solaris. You have obviously political and social risk in Ecuador. You have a group of people behind the company that are underestimated by capital markets, very good people. And you have a deposit, again, that has the potential to be a very large deposit. So I own it. Don't own it if you can't take volatility. I mean, if you look at the stock chart of this thing going back 5 years, the first thing you get is dizzy. So if that sort of thing bothers you, steer clear. If you can stomach volatility in return for exploration optionality, this is superb.
Okay, two more. Marimaca Copper.
I don't know enough about Marimaca to comment, although I like the people.
Okay, and the final one, Nevada Copper.
I don't have enough data myself to own Nevada Copper.
Okay.
Yeah.
I have another question that is copper related. We have ended the list. But what's your take on the Typhoon technology from Ivanhoe Electric?
That's a great question. And the answer is, I don't know. Robert has invited me to come to Toulouse, France, to get an update on it. And given how much money Robert's made me in the last 4 decades, I need to do that.
Yeah.
I have to tell you, Lucian, I was born in San Jose, California, downtown Silicon Valley. By all rights, I should be a technology wunderkind. I'm not. And so, because of my lack of confidence in my own acumen with regards to technology, I'm always nervous about answering these questions. What I like about Typhoon is that the technology would now appear to have proven itself enough that Robert Friedland himself is writing exploration checks around the application of that technology. Robert is a very smart guy, and he is not one who writes checks too willingly. The fact that he's able or willing to make exploration bets based on data generated from Typhoon, rather than merely being a contractor to other people, is a very bullish sign.
Yeah, let's wrap it up with this. Rick, thank you very much for coming to my show. It was great chat as always. And I look forward to see you in person in Boca once again. Thank you very much, Rick.
Well, thank you. I look forward to seeing you in Boca. Don't forget to book a space on the boat cruise. And don't forget, as I think you will, to bring your family. You're going to have a great time. I personally guarantee that.